It is very nice to welcome you all here. Thank you for coming. We gathered here to discuss PGE Group strategy that has just been released, and as well as our first quarter of 2014 results. A quick information for our internet viewers. We are sitting here in front of sell-side analysts and investors here in Warsaw. And now please let me introduce you to our speakers today. Mr. Marek Woszczyk, President of the Board and CEO, Ms. Magdalena Bartoś, CFO, Dariusz Marzec, Vice President for Development, Mr. Grzegorz Krystek, Vice President for Operations and Trading, and Jacek Jost, Vice President for Corporate Affairs. My name is Jakub Freilich, and I'm Head of Investor Relations. With such a strong representation here of full management team, we'll be ready to address your questions followed by the presentations. But first things first, we will now give you a quick review of our operating and financial results after first quarter, and then we move on to the strategy results. This will be followed by a Q&A session. Questions from internet viewers will be sent through formula. I will read them out. And Mr. President, the floor is yours.
Thank you, Kuba. Good morning, ladies and gentlemen. As Kuba has said, we start with our last quarter financial and operational results, and then we move to presentation of our new or updated strategy of the PGE Group. The overall message we would like to send to you today is that we believe that PGE is capable to perform despite of the challenging business environment. In other words, the reports of the first quarter of this year that we've published confirm PGE performance on a currently very demanding market. First of all, EBITDA, it reached a level of 1.7 billion zlotys, which among the other drivers to be discussed later by Magda, CFO, was significantly impacted by a voluntary leave program, which is successfully carried out in our generation business line. So the value of the next wave was approximately 150 million zlotys and resulted in a future total decrease of a headcount of almost 1,000 employees. When it comes to the operations, net generation electricity amounted to the level of 13.5 terawatt hours, which is in fact 8% lower than a year ago. This is mostly impact of decommissionings of our fleet, especially in Turów and Dolna Odra, as well as overall lower demand in the power system, mostly due to the weather conditions. So the winter was relatively cold, and that's why the overall system noticed a little bit lower demand. In terms of the volume of the distributed electricity, we report the increase of 2%. So the level of the distributed electricity was 8.2 terawatt hours in the first quarter of this year. The slight increase, but still increase, confirms that we connect the new customers, new clients to our grid. We also have expanded our retail market share. Increasing volumes sold to end users resulted in the amount of 9.9 terawatt hours, which is 11% higher than a year ago. When it comes to the other factors, the other issues, I'd like to draw your attention to important events that took place last quarter. When it comes to the carbon allowances, in last month, in April, PGE application with investment was finally verified, and carbon allowances for last year, 2013, electricity production were recognized on our accounts. These will be recognized in the second quarter of this year. Moreover, a significant value of investments already conducted by PGE, together with the positive verification for 2013, allows us to expect the same decision for this year emissions. This is of a key importance to the cost base of the current year. And last but definitely not least, with respect to carbon allowances, PGE received also allowances for the heat generation for this year, for the last year, so 2013, and this year, 2014. Okay. Secondly, as we've already communicated many times to the market, we've started the project Opole 2. The notice to proceed, you know, that was issued in January, so the project has been kicked off and is being developed. Thirdly, which also has, let's say, great importance to the outlook of our company, we have noticed increasing value, I mean prices of the forward contracts, both for 2015 and 2016, which is an effect to some extent of, let's say, Polish market specificity, as well as the recent regulatory changes. I mean, of course, the operational reserve mechanism or strategic, in other words, cold reserve mechanism that are in place here in Poland. So this is a brief introduction in terms of the generals. Now I'll give my microphone to Magda, our CFO. She will guide you through more detailed financials, let's say.
Thank you, Marek. Good morning, everyone. In today's meeting, I will provide you with a brief overview of our numbers for the first quarter of this fiscal, and I will discuss very briefly the key developments and key observations we have within the energy sector, energy market, and the PGE Group. PGE Group, PGE Business provided sound operating results as we anticipated. I'll start with a few remarks on the key developments, as said, and observations of the recent months. When it comes to the Polish energy market, what has been already noticed by Marek, we saw a decline in energy consumption. A decline of 1.4 was noted, and we associate that mostly with mild weather conditions of the first months of the year, especially when compared to the last year, or to 2013 winter. That was followed by two other elements when it comes to generation and demand. First of all, we saw a significant impact of increase of installed capacity in wind generation and generation in wind farms in general. There is an add-on of 1.1 gigawatts when it comes to wind capacity installed in the Polish market. Additionally to that, PGE decommissioned two units, one in Turów on lignite and the other one on hard coal in Dolna Odra. That also created a somewhat challenge when it comes to delivering operational results, and we believe we managed to go through all those challenges and impacts in a very good shape. That is also reflected in our numbers. The first quarter of the current fiscal was also impacted with the cost management measures we took. One already being presented by our CEO, which is the voluntary leave program. Our generation business unit decided to announce and account for a voluntary leave program that came at a cost of 150 million Polish zloty, but will also allow us to reduce the headcount base of close to 1,000 employees. That will eventually pay off with labor cost reductions in the current and following years. Our fuel mix was also changing when compared to the prior year. Due to a lack of cogeneration support, we ceased gas firing in Lublin and Rzeszów. That allowed us to save 150 million cost when it comes to gas fuel cost. Hard coal prices, as we anticipated and communicated in last year's fiscal results, were kept at an average, or remained at an average of 2013. And the key development, the development that I'm particularly happy with is that PGE Group received CO2 allowances free of charge for 2013. What is even more important to us is that the investment list we provided the EU and Polish administration with was accepted, but includes enough investment to cover for the CO2 allowances for 2014. That is a very good message to indeed our financials, as it creates practically no threat for us not to receive the CO2 allowances in 2014. That being said, our Q1 journey provides a very promising message for the coming quarters. We proved to be a reliable and sound operator of our efficient assets, but we also delivered additional efficiency measures for the coming quarters. Now let's take a look at the asset performance and generation volumes. Our generation volume for the 3 months of 2014 is 13.5 terawatt-hour, 8% down versus the prior year. As we discussed, production volumes were impacted by both mild winter and the commissioning of Turów and Dolna Odra units. But what is interesting is that as a result of last year's acquisitions of wind farms and new project development in the wind generation segment, we managed to increase, or more than double actually, our wind generated volumes, and our current capacity in installed wind is more than 300 megawatts, which is actually 311 megawatts. I'll now turn to our first quarter numbers. Our sales is close to 7 billion Polish zloty, which is below the prior year figure. The decline is mainly attributable to lower wholesale prices and lack of bilateral contracts. The one we had last year was with Energa. Our first quarter EBITDA declined by 0.4 million year over year and reached 1.7 billion. Half of the decline is attributable to one-off items. Our EBITDA on a recurrent basis reached 1.9 billion. The items that we treat as non-repeatable, as one-off items, are the CO2 allowances, as we will see later on, and long-term contract compensations. Lower earnings of our retail sales division, together with the pressure we had on our conventional generation wholesale price, impacted our EBITDA drop most. Underlying net income decline is mainly attributable, or mainly comes from the EBITDA drop as well. Our Q1 investments reached 1 billion, which is 0.2 billion more than last year. 70% of the capex funds were invested in our conventional generation division, mostly in modernizations of our Bełchatów plant. Our operating cash flows amounted 0.9 billion. The change is also mainly attributable to lower earnings and less significant working capital changes. Let us turn to the walkthrough of the main earnings drivers. We observe the pressure, as expected, on our generation and retail activities. Our Q1 EBITDA is mainly driven, or mainly impacted, adversely impacted, by unfavorable wholesale price changes. As we discussed at year-end presentation, 2014 prices will be a challenge to our conventional generation division. We observed the prices drop by almost 20 Polish zloty per megawatt hour, and that created a pressure on EBITDA, or a drop in EBITDA, of close to 0.3 billion Polish zloty. Another significant headwind is noted in our retail business. Margins are lower as prices drop and green certificates become more expensive, or are at a higher level more expensive than the prior year's figures. We managed to offset the adverse market impacts with fuel costs. That comes with the 150 million Polish zloty of lack of gas firing, as I mentioned before, and lower production volumes. The lower production volume also creates less of a burden on carbon. The CO2 cost is 50 million Polish zloty lower than last year's quarter, which half of that impact comes from lower emissions due to lower production volumes on hard coal and lignite. The other half comes from lower prices. Distribution business continues to be a strong anchor of our stable cash flows and delivered 45, close to 50 million more of EBITDA. That all being said, I can wrap up our Q1 results. The market was tough. The energy sector is still in a very demanding phase, but we observe and we see that PGE is able to deliver strong and stable results and deliver a good platform for our future growth and strategy realization. With that, I guess everyone expects an introduction to our strategy, so I will hand over to Marek so he can give us one.
Okay, as has been noticed previously, now we move to present our strategic directions update in a time frame reaching up to 2020. First, why PGE decided to update the strategy, because we believe that changes in the business environment, especially recent development in the electricity market in Poland, have led us to a conclusion that we need to adjust the previous strategy in order to secure the value creation for our shareholders. So now we'll give you a quick overview of our strategic objectives, and then we'll be to your service if any questions may occur. First of all, we observed that, first of all, some general facts about the business environment that PGE and our competitors live within. So first of all, we observe that although the electricity prices still remain relatively low, they've kept rising for the past few months. And still, according to our assumptions, they have the potential to grow. Secondly, the coal. With the coal, which is relatively cheap, and the gas, which is relatively expensive in Poland, we see a continued coal dominance in our fuel mix. This is, however, some risk attached to CO2 prices in the long run. Not in the short term, but in the long run. We see that. Thirdly, one fact we believe that will persist is that the companies with the access to own fuel sources have the largest value growth potential. This is the key element of our competitive advantage on which we based our strategy. Thirdly, as PGE, we welcomed a new draft law on renewable energy sources support scheme. We welcome that because it aims at rationalizing the support scheme, but it implies that only the most efficient, most cost-effective projects will be deployed. Fifth element, we see the situation of the utilities, especially the largest ones in the Western Europe. This is far from being relaxing. And on the second hand, there is still a need to replace the old generation assets here in Poland. So we believe that our authorities will work out on a wholesale market model update, which shall lead to increased remuneration of generation for the generators, for the generation capacity availability. It should, in a consequence, provide for the larger, higher profitability of such assets. Just as a reminder, we have operational capacity reserve mechanism and strategic, in other words, cold reserve mechanisms as well in place here. So we believe those mechanisms will be in place until the new market model update will be elaborated and implemented. Sixth factor, important one, the downstream element of our value chain, of the value chain of the business like we run, we mean basically retail, is experiencing more and more competition, which has two, let's say, impacts or two results. First one is a higher rate of migration of the clients from supplier to supplier. A second one, drop in margins. It happens in a more developed market, so we should expect that this should happen also here in Poland. So customer retention focus and the margin control must become our priorities, as well as improving the grid reliability, because we are aware that any, let's say, whatever we do with our grid, this will have an impact on the perception in the eyes of the client of our supply. We, as our competitors, mostly concentrate on the historic area. That's why reliability of the grid, despite of the other facts like possible new or updated model of the regulation of the distribution assets, is very important factor. So this was about the business environment, and now about the PGE itself. You know most of these facts, but the most important figures I'd like to draw your attention to. Our brand is becoming more and more recognizable. That's good news for us from our perspective, but it's always to know the company current status before I'll tell you about the vision of the PGE in 2020 perspective time frame. So it's obvious that PGE was and still is the largest and most profitable energy group in Poland, with the revenues over 30 billion zlotys per year, and recently reported EBITDA of 8 billion zlotys. Since 2010, our growth is stable, with average figure of 6.5% annual rise of an adjusted EBITDA. As well, we keep reporting the EBITDA margin much exceeding the market average, as you see in the picture. So we retain a strong position in all segments across the value chain, but of course the almost 50% comes from, our EBITDA comes from the generation segment, in particular from the conventional generation segment. We also become a major player in the renewables after the last year purchases. So now we have the largest wind power generation portfolio. In the distribution segment, we generate almost 30% of our EBITDA. This is thanks to two factors. The first one is stable regulatory environment. The second one is the market share of 26% that we have in the distribution. We also the leader on a wholesale market level, thanks to our competences in terms of the financial modeling, in terms of the forecasting of an energy market, and in terms of the asset-based trading. When it comes to retail sales, you know that we are not the leader, but we occupy the second position in the market. In terms of the sales volume, but we take advantage in that segment of the market of our large SME and the mass customer base. As I said, the generation, this is the part of the value chain that contributes the most to our EBITDA creation. It's good because we have the most competitive generation portfolio in Poland. Our assets are situated on the premium places under the merit order curve. Thanks to the cost-efficient fuel base, I mean lignite, we don't expect that situation to be changed. In the future, we expect rather to maintain that competitive advantage thanks to the new investments already launched or those who are about to launch, I mean Opole and Turów, as well as a rich retrofit investment program. So we will focus on keeping our generation fleet as most efficient as it is possible. So taking into consideration what I have said about the business environment, the one that we lived and we live within, and the one that is forecastable from our perspective, that's why the 2020 timeframe we see as a deadline, let's say, as a limited date of our strategy directives. We decided to build the vision of the PGE in 2020 on 4 strategic pillars, all glued with innovation factor. So in 2020, we believe that we will be positioned as a leading electricity producer in Poland, but with the most effective and optimally diversified asset portfolio. This is for assured long-term competitive advantage based on domestic resources. Secondly, we have aspiration to be a preferred or favored and reliable supplier of electricity. In other words, first choice of the customer should be PGE. This should be based on the optimal supply, sales, and the customer service process. Basically, we have a lot of potential to improve our operational efficiency. Thirdly, we strive for being most efficient power utility in Poland as a result of a set of efficiency improvement programs. We would like to refer to the best industry standards. And third and fourth factor, we want to be a group that actively develops new business areas aimed at value growth. So these strategic aspirations, as I said, will be based on innovation that should be understood as a continuous analysis of the market environment and identification and then implementation of innovative business solutions. So this was a brief introduction, generals, on our strategic directions. Now let me pass the microphone to Mr. Marzec, who is responsible for not only for development but also for the strategy. He will give you more details on each element of our strategic pillars.
Thank you very much, Marek. Ladies and gentlemen, I have a pleasure to present you and go through some more detailed pages on our new strategy, and I'm going to go through those main components of our strategy and provide you some explanations, and happy to take questions after that. First of all, in terms of leading producer, what does it mean for us? That we going to maintain and to improve our leading position in the electricity generation. That's a major area of our business, and we are going to do that through two major kind of activities: the modernization of the existing fleet, modernization to make this fleet, which is the youngest fleet in Poland, to make this fleet more efficient, more environmentally friendly, and to reach, first of all, to improve competitiveness of those generation units, but also to improve their impact, or to reduce their impact on the environment, and to reach and achieve the highest possible environmental standards. That's the modernization segment, and the new units investments, building of new units in Opole and Turów. That's the very modern, environmentally friendly new units which are going to be very competitive on the market. As you can see on this illustrative merit order, those units will be placed in the baseload part of the market, and we believe that we will be able to fully utilize them, and they're going to be competitive and very efficient. In the same time, as you can see on the bottom of the page, those modernizations and investments will significantly reduce level of emissions on our group, because we are quite emission intensive as electricity producers. So we, in terms of SO2, NOx and dust emissions, we are reduced significantly the level of those emissions. Next page. As you can see also in CO2, our portfolio goes in the way of reduction of the general emission of PGE Group, and we hope to achieve by 2030 about 25% reduction on our CO2 emission. We are not only focusing on conventional, we understand the need of the diversification of our portfolio, and this diversification has to go through the units and has to go through the segments with low or zero emission technology, which comes to implementation of the nuclear program and preparation of the construction of the first nuclear power plant in Poland, which we hope to make the final investment decision by 2017, once we finalize our integrated proceedings in that respect. And we hope to start construction of the first power plant, nuclear power plant, in 2020. The another segment related to low emission or zero emission electricity production is our wind, our renewable segment. In that segment, we are investing or constructing 234 megawatts by 2016. That's the projects which are currently under development and construction, and those projects should be ready by end of 2016. But as you perfectly know, the regulatory environment in renewables, it's in the process of changes. So our another 880 megawatts portfolio will be reviewed and developed based on the new regulation, or based on the adapted regulation and support system for renewables. As a PGE group, we would like to maintain and develop our also as a leading operator of regulatory assets. We have a number of them. The main assets are Dolna Odra power plant or pump storage plants. We keep them updated. We keep them. We modernize them, and we believe that those assets play quite important role for the operator in the Polish or provide stability to Polish electrical energy system. Cogeneration, 187 megawatts under construction, in development, but as again the long-term support system is not in place yet in Poland. We are facing right now the temporary solutions for the next 3 years, which are, let's say, suitable for the existing assets. But with the portfolio of our over 1,000 megawatts cogeneration investments, these decisions or those projects, they need, let's say, long-term support system. And once this support system is developed and introduced, we will, let's say, continue with decision process related to those over 1,000 megawatts cogeneration portfolio. As it was mentioned a couple of times during this presentation, we are not betting on one scenario. So we are trying to diversify and secure our main strategic options and main strategic directions. Our main part of our generation portfolio is conventional, so in case that that conventional segment will be able to develop, and we will be able to develop another conventional plants, we secure the reserves, and we secure base and reserves for new generation units in conventional. We're concentrating on Złoczew and Gubin. We are not exclude other acquisition opportunities in the fuel resources area, but we secure for the time being, and we proceed with the administration permits with 1.4 billion tons of new reserves, which could be used by our group in the future in case of the development of the conventional segment in energy sector. In total, our investment program by 2020 is about 50 billion Polish zlotys, when about 30% goes for new conventional capacity, which is Opole and Turów. About 33% it's modernization of the existing generation assets, modernization, upgrading, mainly efficiency and environmental standards. And 25% of this investment program is dedicated to distribution segment. We also intend to develop, in terms of the investments by 2016, the nuclear program, and we budgeting 0.7 billion zlotys for this period for development of this program. In terms of the sales, our intention is to be preferred supplier. We would like to make attractive offer for the customer, but attractive from the quality point of view, and attractive from the, as Mr. Woszczyk said, our brand is more and more recognizable, so we would like to be perceived as a stable, Polish, reliable supplier. We will concentrate on effective trading strategy. We would like to concentrate and develop our understanding of the needs of the customer, and improve the quality of the service we offer to our customers. In terms of the quality, it goes together with the quality of our distribution network. We intend by 2020 to invest over 11 billion Polish zlotys in the distribution network to reduce the SID measurement of quality of the distribution network by 50%, which is quite significant improvement, and will support our preferred supplier and reliable supplier perception by our customers. But this needs efforts and investments, and we also focusing and spending a lot of time and effort on our distribution network. The group is going to be and will continue efforts in reorganization, restructuring, improvements, cost reduction, and increase revenues. The number of projects, initiatives are implemented, or we are working on them within the group, and our aspiration and our target is that after 2016, the sustainable and repeatable impact on the sustainable impact on our operational profit should reach 1.5 billion zlotys through implementation of all of those initiatives in all in all group segments, in conventional generation, distribution, and renewable energy. As you know, the energy sector is more and more regulated, is more and more about regulation. We intend to implement very integrated and based on the group interest approach and dialogue with the regulation authorities on different level, on Polish level, and also on the European Union level, because all our segments and our developments, our plans and investments needs stable and predictable regulatory environment. And talking about segments, conventional segment needs some predictability and needs some encouragement mechanism for the new investments. Nuclear and renewables, they need economical predictability in terms of the support systems, long-term economical predictability as it's provided for renewables today, and the new system also provides some support for those investments. The same is needed for the nuclear. As you can see, the dialogue, and we observe the dialogue of British government with European Union in terms of the development of the nuclear investments. We focusing on those experience, and we're focusing on the results of these discussions, and we will propose to Polish government also the solution which would let us to develop this program and make this nuclear power plant successful from the economical point of view. But also distribution segment needs constant, as a regulated sector, needs a constant dialogue with the authorities. We intend to integrate all of those efforts, coordinate between those segments, and make the consistent and group-oriented approach to regulatory activities or authorities in Poland and also European Union. Internally, we also reviewed and we are implementing number of initiatives to improve number of internal processes. We are implementing best corporate governance practices, internal within the group. In human resources, we are developing and we are focusing on the development of our people, but we also intend to increase efficiency of our processes and standardization of those processes, optimization, and number of initiatives to save or to reduce costs. And we implement that through the new operational model. And one of our priority projects is implementation of the operational model with the clear allocation of the roles and responsibilities within the group between corporate center and our business lines, and with the clear division of those responsibilities when corporate center would be and will be responsible for the strategy development, for the margin management through the whole value chain, investment and operations supervision, optimization, regulatory dialogue with the authorities, and delivering to the group support functions. Once the business lines would be focused and will focus on the day-to-day operations, efficient operations, support of the decision process in the headquarters. As it was mentioned, we as a group would like to first of all to understand where utilities goes these days. Then the model of utilities, European utilities, is changing significantly, very dynamically, as we can observe our peers in the Western countries. So we would like to understand what is potential impact on PGE Group and how our business model should develop, having these observations. Secondly, we would like to develop new business areas. We identify initially some of them. We believe that dual fuel offer for our customer is one of the most promising, very promising areas. Energy services for the customer, and a lot of projects which are related to e-mobility. We generally intend to prepare number of projects analyzing new business opportunities, how we can create value for our shareholders, where our experience and group potential can be in the most effective way utilized to generate new businesses. We don't want to generate and create new businesses in the areas which we have no competence, but we would like to go into those directions where our competence and group potential and experience can be in best way utilized. As a PGE group, we would like also to focus and to spend a lot of time and effort on the innovation. On the innovation area, we decided to allocate a fixed amount of the annual net profit for the innovation. We implement the stage gate approach to those potential innovations, to those projects. We develop the strategy of cooperation with the academic world, the science centers, and other institutions who are developing the R&D activities. And we believe that that's also area where group should be active, where initiatives which have potential to improve our operations or improve value of the group, they should be identified and implemented. In the top of that, we intend to continue, and we would like to underline this. We would like to be perceived and effectively and really be a socially responsible group, and that's going to be implemented through security of supply of electricity and reliability of our distribution network, sustainable development, so invest in technologies which are to the possible extent environmentally friendly. We reduce emissions. We are developing low emission segments of our business, but also we would like to be corporate social. We base our operations on the corporate social responsibility, and the number of initiatives in that area is developed within the group, and we would like to those three components to be visible, and our business is based on those three fundamentals. And summary, okay. Mr. Włoszczyk.
Thank you, Darek. Just to close our presentation and open a Q&A session, let me recap some key themes, key issues of our updated strategy. So, first, as it's been mentioned, in order to maintain a leading position in the generation segment of the Polish market, we conduct and we will conduct an investment program by 2020 worth in total close to 50 billion zlotys. So secondly, in terms of the nuclear power project, it will be implemented in a business model that assures the profitability of investment in the long run. Thirdly, in terms of the CHP and renewables, especially in the wind farm generation, our capacity additions, yes, we plan the capacity additions. However, it depends on the long-term support scheme shape. The next element, we continue to secure fuel base for our conventional energy assets as a strategic option for the future. I talked about that in my initial word. Next element, we target at the full utilization of our assets. I mean regulatory assets. We have them just to benefit from its energy security value. I used to always say that PGE is to provide the energy security and earn on it. Yes, we've got such type of assets. I mean generation units that, of course, allows me to tell it to you. We would like to be a preferred and reliable energy supplier, which means that we are to reorganize our sales process as well as we will focus more on understanding the customer's needs, more on the customer service improvement, and more on cost to serve optimization, generally speaking. In terms of the distribution, we aim at reducing of the cuts of deliveries at 50% versus the current status of the matters. Generally, by 2020, we will focus on our effectiveness as a capital group. So capital group that's been consolidated, so formal act has been done, but today the process still continues and will concentrate in particular on efficiency on how we operate. So we expect that it shall bring sustained impact on our operational result, I mean EBIT of 1.5 billion zlotys starting from 2016. Just to utilize the potential of our regulatory nature assets, we will hold a dialogue with different stakeholders in the area of regulatory environment. As I said, we aim to optimize our management processes, support functions in the line of recently elaborated operational model. In terms of innovations, in terms of the new business areas, we will actively develop new products and new businesses, mainly in those areas that we've already identified. Last but definitely not least, just to increase our innovativeness, we will analyze the market environment, as I said, to identify and use any innovative solutions that will occur profitable and just to achieve our strategic goals. Of course, our strategic aspirations, our strategic directions will have a material, financial effects. As you may see on this picture, we ought to keep our EBITDA level in the range between 8 and 9 billion zlotys in the strategic periods that we talk about. We ought to maintain the current policy of the dividend payout, so between 40 and 50% of the consolidated annual net profit we will offer to the market, to our shareholders. Okay. 1.5 billion of a sustained influence on EBIT in a strategic time frame period as an effect of the planned activities related to the effectiveness improvement, as I said already. Of course, we're keen on maintaining our good long-term ratings, no doubt about it. Close in terms of investment, CapEx, as I said, close to 50 billion by 2020 we should spend. And that last but again not least component, innovation, we decide to spend at least 1.5% of our annual net profit on R&D activities in order to develop new business areas, just to provide for achievement of our strategic goals. So as we are aware that we presented a lot of pieces of information, so you might be eager to know some more details, so we are ready to answer all of your questions.
Maybe just one remark only. Could we focus on the strategy first, as this is the latest news that we provided, and we go through the results if needed later on? Thanks. The floor is yours.
Hello, Milena Szewska, ING. I wanted to ask about cost reductions. If I understand correctly, the amount given in this strategy is some 500 million higher than in the last one. If you could firstly please tell me what areas contributed to the growth, and secondly, if we could please split this 1.5 billion by segments.
The 1.5 cost efficiencies come in majority from our conventional generation division. The amount itself is a follow-up of our previous efficiency improvement programs that we communicated. This has been worked on, and new measures were planned and estimated to be in the area of 1.5. So as you might remember, in the EBITDA drivers for the fiscal year end, we communicated $500 million of efficiency measures already realized. We are adding $1 billion on top of that and strive to deliver a continued saving, annual saving of 1.5. The base year for those savings is 2010.
Good morning, Michał Potera from UBS. I have a follow-up on those cost savings. Should we just assume that if the costs were, say, 3 billion, now those costs will be 1.5, or this, say, hypothetical 3 billion should be inflated with inflation, and only from that we should subtract 1.5?
Mathematics is never easy with those type of comparisons. We are, of course, trying to estimate those cost savings as a comparable. However, as we were saying in the summary of the presentation, those are our financial aspirations. So it does not mean that numbers are scrutinized to the level of details that would tell us each of the headcount or each of the process that is being streamlined. So of course you're going to have different measures that, or different impacts that will cause your costs inflate or that will cause your costs decrease. The 1.5 is a measure of costs that we would like to avoid starting from 2017, comparing to, as said, 2010. Having in mind that the majority of that was being realized in 2012 and 13. The current voluntary leave program is, for example, such a measure that is also part of this 1.5.
Okay, I'm not sure if this really answered my question, because I think that's, but okay, let's leave it here. Because the thing is, I kind of find it hard to reconcile this $500 million you saved. You don't really see that in the financial statement, that it's not very clear. But okay, maybe I have a question on CapEx. In the presentation you guide 700 million for a preparatory works for the nuclear power plant until 2016. And also you write that the decision will be taken in 2017, depending on the support, etc. So I'm wondering what will exactly cost 700 million? Thank you.
That's the preparation of the biggest investment for the last 60 years in Poland. The site localization, for example, the all research, all the checks we need to do on the related to the site integrated proceeding. That's the budget. We are not telling we will spend those money. That's how we budget in preparation of the project. That's the integrated proceedings, but the vast majority of those money is the technical work related to the site. Analysis, potential sites analysis, environmental analysis, environmental impact analysis, and preparation, owner's engineer role, preparation of the everything related to the integrated proceedings. We intend, and the timetable for the nuclear program assumes that by the end of 2016 we hope to finalize the integrated procedure, and in that time we will know Do we have potential partner? What is the cost of the technology? What is the time period from the construction? And that's why 2017 should provide us with all major components for the final making of the investment decision. Also, potential shape of the support system for the nuclear, and we hope to start construction 2020. The contract with the consortium around 2017 and 2020 start the construction.
So there will be almost no tangible assets in the 700 million. It's mostly advisory.
It's not advisory, it's the project preparation. No, it's not investment, but site analysis and preparation mainly. Okay. Sites, potential sites.
Yeah.
Not tangible assets. Not
seems
tangible
really
assets.
a lot.
Yes,
at least
that's a quite big. That's a quite big project. If you can see the comparison to the UK projects, we are spending much less than comparable project. That's the huge.
Hello, Piotr Warek from Trigon. I've got two questions about the strategy. On the page 7, you've got the merit order estimation in 2020, and I've got two questions about assumptions. First is your assumption about wind capacity growth, and the second one is about that. Do you have any? Do you see any risk related with the problem of the merit order that can be set on the new power plants, not the old one? And the second question relates to problem with the Polish coal producer, and can we expect any changes in long-term contract? Yes, and do you see any risk related to that topic?
As far as I understand your question, as we said, we don't expect any changes in terms of the comfort of the place that we occupy under the merit order curve, at least in the time frame of our strategy updated. So 2020, we don't expect the changes may occur or may affect us in any way. Why? Because we have a lignite, which means that we control and we will control the whole value chain, okay? From exploitation to production and sale. In terms of the hard coal, if you look at the global situation in hard coal supply, there's generally a situation of oversupply, which puts a pressure on even on a domestic, say, miners in terms of the prices. So we rather expect that those prices should remain flat by 2020. Okay. In terms of the wind, as we said, all depends on long-term support schemes. So renewable draft law act on the renewables is of a crucial importance right now. However, we see that we don't expect, let's say, the major change of that what has been presented already by the government. I mean, the auctioning, which is nothing more but about picking up or bringing to the market only those investments that are the most effective, the most cost efficient. That's it. We would be more than happy, for example, if there would be no primary dispatch rule for renewables someday, but we shouldn't expect it by 2020 because no European Commission documents says on it. Maybe after, there are some, let's say, European declarations that maybe after renewables should be an element of copper plate as the other technologies, but not by 2020, so we do not expect that. In terms of the wind capacity growth, not mentioning or not taking into consideration only our share of the market in terms of the wind, but I assume that you asked me about the total share of the wind generation in the Polish market. Yes, it may grow, but rather in a moderate, with a moderate dynamic. And that's why we talk explicitly about the need, not only we as a PGE, but generally the whole generation sector, the whole power sector, not only tells that, but also work on it right now to update or to modernize the market model, at least on a wholesale level. Operational reserve mechanism, strategic reserve mechanism, these are the first elements of the so-called capacity market, so which provides for better remuneration or high remuneration of the capacity that is available for the system, available upon a call from a TSO. So we believe that this will continue because our business environment, not only here in Poland but generally in Europe, tells us that everybody is seeking a solution on how to provide for, let's say, security of supply from the conventional power generation, because the other technologies like large-scale storage of the electricity are not yet visible on the market. So that's why we picturized that our position in a merit order by 2020. We don't expect any, let's say, risky changes in terms of our comfortable situation, briefly speaking, where we are.
Maybe one more sentence. We believe that the dynamic of the growth of the renewable, the growth would be much less dynamic as a new regulation, we believe, should rationalize the costs and to the system. So those conditions of the new regulation will not be so attractive than the current one, which should keep this dynamic a little bit lower.
Good morning. I'm Grzegorz Witkowski from Trident. So I would like to continue on the question that my colleague already touched upon regarding the coal sector. We all heard the remarks from the Prime Minister recently, who told that the utilities cannot concentrate on profit only and are a tool of the state energy policy. And my concern is, of course, we as a financial community understand that with your ambitious CapEx program, there is really little free cash flow left for any further involvement, but I'm not sure if everybody understands this, and if you look at the EBITDA alone, that somehow fulfills the condition that utilities earn huge profits and should somehow share this with perhaps some other sectors. So what's your comment on that? You haven't put any slide on your possible involvement in the hard coal sector. How would you comment on all those issues?
Well, hard coal mining is not our core competence, you know that. But in terms of what Prime Minister has said, I must say that we couldn't agree more, because there is no contradiction, because between the business and the security of supply, as I said, at least in terms of the PGE, we are the leader in terms of the base load, which means that we earn on a security supply or on providing the security. Focusing solely on the short-term financials would mean no growth in terms of investment. Limited expenditures in terms of the maintenance of the assets, potentially full payout of the dividend for the shareholders. I mean, full profit to be paid out for the shareholders. Okay, short term, yes, short terms. This is the situation in the short term. So we are not the company of one day. Okay, we think in the long run, and we want to provide in the long run the value for our shareholders. So I think that in order to bring about the more energy security, because this is what the Prime Minister has said, probably this is my, let's say, estimation, my opinion on that, might require rewarding such capacities for such such a commitment that we may provide to the market. Prime Minister has said that security of supply must cost a little bit, and it needs a proper reaction from the authorities in order to help the market to provide the customers with the energy, with the energy security. As I've mentioned, I'm repeatedly coming back to those solutions that have already been adapted by authorities. Capacity reserve, operational, strategic, called. Okay? And works are ongoing. Well, I wouldn't disclose probably too much if I tell you that in June you may expect maybe the publication of the first draft of the common position of generation sector of Poland in terms of what capacity market might look like, and this will be submitted for the public consultation, public discussion. Finalizing my response to your question, I don't see any contradiction between, let's say, long-run security of supply and the creation of the value for the shareholders by such a company as a PGE. But as I said, coal mining is not our core business. We concentrate on the type of the business as we're trying to describe and present with our strategy update.
So if I understand your answer correctly, you don't want to involve in capital terms the coal sector.
Well, we are among our competitors. We are the largest consumer of the hard coal in this country, because yearly we buy close to 7 billion tons of hard coal. Million, sorry, yes, okay. I missed the figures. 7 million tons of hard coal. Mainly, by the way, mainly from Kompania Węglowa, because I assume that somewhere in the background of your question there is a Kompania Węglowa issue. And but generally, 99% of the coal we buy from the domestic sources of the coal, which means that the money we pay to the hard coal mining sector, they stay here in Poland and may commit for solving the problems of mining sector. That's true, obviously. We have a long-term relationship, business relationship, contractual relationship with hard coal mines here in Poland. It's a 20 years contract. I mean, this is, let's say, extraordinary situation which stabilized both businesses. I mean, our business, energy business, and as well as a hard coal mine business. What I may say more.
Thank you.
So one more question from my side regarding nuclear plant. Yesterday there was a conf call with ČEZ, and ČEZ management specifically said they are not going to pursue a nuclear project without state support. And I was wondering if you could give a similar guidance, and you mentioned some sort of form of subsidies or support. If you could elaborate on that, please.
This scale of investment as a nuclear program needs, I would prefer if we call it economical predictability of the project. I think the subsidy is the wrong word. The economical predictability means that there is some kind of economical path agreed between the customer or between the market representative and the investor to make this project predictable in the long run. And that's having in mind the magnitude of this investment, that's absolutely key. So I would agree with my Czech colleagues that this kind of mechanism is necessary. As the British example proves, and as a British case proves these days, that such mechanism was developed, or proposition of such mechanism was developed in UK, and now is the in the phase of the dialogue with the European Commission. So we believe that whatever is agreed or is acceptable from the European Commission point of view, we will make best effort to adapt or to adapt such proposition to Polish conditions and to develop such proposition to Polish conditions. Responding specifically to your question, for the time being, the most popular and favorable mechanism which is considered in this case is a contract for difference. But please remember that contract for difference secure both sides. If the market price is higher than strike price agreed with the second party, then producer return money to the system. If the market price is below the strike price, an agreed path, then some compensation is in place. So that's rather insurance and security and predictability of the project, but definitely not subsidy, and definitely not subsidy, but agreed predictability and financial path for the project in the operation of the plant, and that's the answer.
Okay.
So generally speaking, the nuclear project definitely needs stable, predictable business environment, in particular financial environment. So with no such environment, whatever type of the support scheme might be. Yes, CFDs is on the top today. I mean the application, possible application in our neighborhood, okay? But with no such a practicability, with no such a mechanism, such a type of investment could not happen.
Okay, so maybe just one more question about the guidance. Because you guide for EBITDA starting from 2015, and I just wanted to make sure if I understand correctly that if I if I assume that you're gonna reverse the 750 million provision, CO2 provision, you wouldn't make it with 8 billion EBITDA, and this is why you're guiding for 2015 onwards, 8 to 9 billion EBITDA.
During the year-end presentation, we discussed what the potential impacts for our EBITDA in 2014 might be. So the 2013 EBITDA is of 8 billion, and we estimated the impacts, or we discussed with you the impacts of 2014. Our strategy gives you guidance starting from 2015, as we believe the market conditions and market environment starting from 2015 is much more much more predictable for us, and comes to a stable situation that actually shows a regular business performance based on the strategy that we show.
My initial question was about Kompania Węglowa, but that's been answered. But let me follow up on two other topics. One is still the nuclear power plant. Here in your strategy presentation, you very nicely presented the impact of Opole for the merit order. And I'm wondering what would be the impact of a nuclear power plant that would be, I would assume that would really push out of the market a lot of the coal-fired blocks, and also just somehow it connects with the topic of the hard coal market. It would also make life of the coal industry much more difficult. If you could please comment, especially on the merit order. I understand that the coal market is...
Of course, the nuclear power plant goes to the left side of the merit order, because this plant is going to work on in the base load. But we believe that this power plant and this generation units will replace as you can see, old coal units, which will be decommissioned anyway because of the environmental. The Polish significant number of Polish generation units, they have to be decommissioned or replaced by the new ones. That's why we place our investments, and our units are vast majority of them, and all of them working base loads are on the left side of the demand prediction. But in our analysis, of course, we assume that longer than 2020, or making predictions of the market after the nuclear power plant is built. We include the contribution of nuclear power plant in the generation system.
I understand, but simply my assumption is that basically a marginal producer would suddenly become very efficient, and the price could really collapse. And because the details you showed during the new Opole presentation assume that there is a gradual and growth in the power price. So I wonder if the nuclear power plant wouldn't completely change the prices on the market. But
the nuclear power plant would be much below 10% of the general consumption in the market in the given time. That what we predict is about 3,000 megawatts. That would be below 10% of the total generation. So it's not the power plant which completely reshape the market at some low emission production, but it's still below 10%. We don't perceive a nuclear power plant as an investment which would reshape Polish generation segment. It's going to be still conventional for the next decades, and power plant is nuclear power plant is rather diversification, and will replace the old units which after 2020 anyway would have to be decommissioned.
Okay. So maybe jumping, if I may, last one to a different topic. With the changes in the anti-monopoly office, in the past, PGE was looking to consolidate the industry in Poland. Is it back on the agenda, or is it a closed topic for you? Thank you.
Maybe you know more than we on that topic. Well, I assume your question is about our strategy in terms of M&A's potential.
Yes,
Yes,
of
okay.
course.
We have to say that, of course, the domestic market is, let's say, the core field of our business. We want to focus, concentrate. No doubt about it, which means that we don't exclude M&A's potential, but it depends on the, say, profitability of such acquisitions. Okay, it should be in line with our strategy in terms of the, let's say, components of the value chain we want to concentrate on, or generally in terms of the features we want to bring to the PGE's image. Okay, but first of all, it has to. This has to be a business case for us. So I may only respond in the general terms to your question today on such a type of a question. Absolutely honestly.
Thank you.
Maybe for a minute we'll try to give a voice to our internet viewers. We have a few questions from Morgan Stanley, from Igor Kuzmin. First relates to distribution. From the expected EBITDA of level 8 to 9 billion, how much would come from the distribution? And a follow-up. Does the strategy assume that the overall capex of over 12 billion for the development and modernization of distribution assets will be recouped in full through revenues and hence will generate the returns above the cost of capital?
About the distribution business EBITDA contribution to our business, we assume the shares of the current level and add on of a low to mid-single digit growth of EBITDA for distribution. That does not really change the picture of the share of distribution in the general earnings of the group, and those would still equal or amount to approximately 1/3 of generated EBITDA.
And also a follow-up on the distribution. Will the investments return on the investments planned be over the cost of capital? Is this going to be affected in the remuneration in the tariff?
Probably.
Yeah, that's our expectation.
The effect shouldn't be a major, I would say, to the spread. Okay, I've already talked about that. The new regulatory model, this is a better question for the regulator, okay, but the new regulatory model that we expect shouldn't bring, if you mean, too much harm to the existing regulatory model in terms of the WACC, especially because the quality factor would have an impact of the future regulated WACC, but to very moderate degree, I would say. Okay? So it's rather, let's say, testing phase or evolution from the existing model to the new one, but not a revolution. I mean, we don't expect deterioration of the existing regulatory model in terms of what is remunerated, in terms of the incentivizing the new investment, incentivizing automatization of the grid, improvement of operational efficiency of the grid operations, all those things. So, but rather concretizing or focusing on the concrete elements on the quality of the service that should be offered or delivered to the clients by the DSOs. This is a dialogue, current status of the dialogue between the sector, distribution sector, and the regulator.
One more, which relates to our lignite resources. How much from the planned capex is expected to be allocated over lignite resources, apart from Turów?
Lignite reserves, those new reserves? Those new ones.
It's not, if we're talking about this 1.4 billion tons, which we secure this through the relevant permits, and to obtain permits. Now we are in the stage of development and preparing for the administrative permits. There are no very significant investments, and we are talking about millions. It's nothing material and significant from the investment point of view, because it's just development of the concessions and some research work on the sites. But we are protecting them to be eventually to develop them, those reserves, if necessary. We are not investing in them heavily these days.
And a question on our assumption for EBITDA in 15/20th. What would be the assumptions for power prices and carbon steam coal production volumes?
Somebody needs support for the model.
We were very consistent with our assumptions to the assumption set we discussed during our Opole presentation. So when it comes to the electricity prices, this one is actually a result. Let me start with the input first. We assume the CO2 prices to follow the talk of the EU. Namely, we assume growth up to 10 euro per ton in 2020. Later, when it comes to to coal prices, we assume the coal prices in the nearest future, in the midterm, to remain stable to current coal prices and later to grow moderately with the expectations of international agencies. And as a result of that, we expect the electricity prices to grow moderately at the pace of CAGR of 4.8%.
We have one more question related to strategy from individual investor, as I read, unnamed. What measures will be taken to address SID improvement?
In distribution, we run very wide program of both improving effectiveness of our investment and improving our operations. As President Marek said, the new regulation scheme will consist of improvement of the effectiveness and better service for our customers. We believe this investments and programs we are running will implement to this assumption.
We can go back to the room now if there is some follow-up questions.
Again, if I may now turn to 1Q results. I'm looking at the retail segment.
I'm not sure whether your microphone works.
Hello? Okay, thank you. I'm looking at the retail segment profitability, and it went down to 0 in the quarter. And here two elements. Firstly, visibly PGE was taking share from competitors over the past few quarters. And my question is whether those new clients are on or 0 margin or possibly on a negative margin. And also, following on that, is it possible that you would have a loss in this segment, given that starting now, also the company will have to redeem red and yellow certificates? Thank you.
Last part of your question I will answer. At least the green and yellow not green, but red and yellow, sorry. It's red and yellow, CHP, coal-fired or gas-fired. Red and yellow certificates, yes, the Energy Regulatory Office published yesterday the new replacement fees for both types of the support schemes. And our calculations are telling that, yes, we expected this year negative impact on the retail of a number of couple of tens of millions. This is not a significant from our business perspective, but still this is a negative impact. But we believe that our competitors will suffer more, of course. This is not a good information for the market, but okay. We will apply for the tariff amendment to the regulator, but the decision of the regulator, okay, you don't have to ask the regulator about this decision, we'll see. But anyway, these are costs arising from the law. If there is no tariff amendment, as I said, the impact on our result on the cost side, basically, the costs will be higher of a couple of tens of millions on the retail side.
Okay, we go back to our internet viewers. We have a question. My computer freezed. Okay, give me a second. Can we go back to the room now? Is there any follow-up questions from the room? Tomek?
Tomasz Krukowski, Deutsche Bank. I have two questions referring to the results. The first one, is about the P&L of the conventional generation division, and in the revenue line I see the sale of certificates of origin is 160 million, it's more times higher than a year ago. Can you tell us what is behind this figure?
Can you please repeat your question?
Yeah, in conventional generation division P&L, the revenues from sale of certificates of origin, this is 160 million. A year ago, it was only 30. So yeah, it was a huge growth, and what is behind that?
The change in revenues of the green certificates, because the conventional generation segment produces green certificate in biomass combustion or co-combustion. Once we receive those certificates, we trade those in the exchange, and then the sellers acquire those to redeem. This year's revenues were higher because of increased cost, so increased price of the green certificate. That is an impact that you see, that is also an adverse impact that you see in the retail segment. So retail is bearing more cost in order to redeem green certificate, but on the other hand, the conventional generation, because of production of green certificate coming from biomass, is having higher revenues.
Okay.
Additionally, we commissioned the new unit in Szczecin power plant, which is biomass fired, and we had some green certificates that were stopped by regulation office. Those certificates were also put we received those certificates last year, so that's part of the growth in the sales.
So how much was this kind of sale of inventory or sale of something which was not referring to this year?
Don't have this figure right now. We can send it to you.
So 160, it's not kind of fully recurring figure, which I should expect to be repeated in the upcoming quarters.
It is because majority comes from our, as Magda said, cogeneration, co-firing and generation on our biomass assets.
Okay, thank you. And the next question refers to accounting of free carbon allowances, because in the first quarter you again made provision for free carbon allowances. You said in the second quarter you are going to release provision which refers to 2013. But what's going to be with the provision which refers to the first quarter, and what's the policy with regards to that?
The first quarter CO2 allowances that we provided for and we expect to receive free of charge is 136 million, and this number will be released in the second quarter. Starting from the third quarter, we will have a regular result of CO2 included in the conventional generation segment results.
Thank you.
Okay, we have some more questions from internet. My computer is back again. What were the factors behind distribution volumes, behind distribution growth of 2% year on year? Could you give some more light on that? In the first quarter, yes.
The key impacts on the distribution business in the first quarter comparing to the prior year figures are growing volumes, especially in the B tariff. We see B tariff volumes grow. We also had some efficiencies when it comes to network losses that we realized. Another important factor are operating costs together with provisions that we reassessed. Altogether 45 million, mostly coming from the asset performance, be it better volumes or another important one is lower losses.
And given the guidance for the 15/20th, could you give some more light and clarity on 15 targets with regards to the drivers? Is the power price to impact it, or the cost cutting in place to be in 15?
The reason we are hesitating is not that we do not know the answer, but that there are so many important factors that we actually guided you through the presentation that it's difficult to summarize in a single sentence. And a noticeable amount of efficiencies is expected in 2015. We also expect the price of electricity to grow in 2015, and I would say those would be the two major ones.
Are there any further questions in the room? Because we will be wrapping up. Apologies to the internal viewers, those questions that were not answered, and some were either partially answered, and we will follow up with our emails afterwards. So, question to our guests here. Okay, thank you very much. See you in August.